You know,
JP, good to see you, buddy.
good to see you as well, Lewis.
So JP is our Chief Investment Officer, and he's been doing a lot of work on the economy and stocks, and we've been making some pretty wholesale moves, and that we're very pleased with. And we were just chatting a little bit before this video, so we thought we'd do a informal video just to get out to our clients to talk about what we're seeing right now. So, JP, when we were discussing how we're looking at what this looks like at the end when we're done with this bottom. What is it going to look like? How does this bottom feel or look like it's going to transpire? And one of the things we were talking about is just kind of the behavior of businesses as a rehire. Can you tell me some of the things that you're seeing with how this bottom, could occur? At some point, it's going to occur. We don't necessarily think it's happening right this very moment, but what are your thoughts about how it could occur, with businesses and hiring and that kind of thing?
Yeah, I mean, I think we're all trying to wrap our head around the magnitude of this thing. So far, everybody has underestimated the impact to it. For example, last week we had our first initial unemployment claims, which were at 3.2 million. People like Goldman Sachs had projected 2.5 million, 2.25 million, so they missed it by 1 million, right? So that's more than a rounding error. Now people are projecting 4.7 million more. So you're talking about numbers that make anything historically look like a blip. So I think there is a bit of an underreaction almost. So here I think we're trying to balance. Is there any more bad surprise to come that is not currently priced in markets versus maybe we have overreacted and all there is left is upside. But so far, at least on the jobless claim side, we're seeing a much bigger impact than even we expected. So a lot of things really ground to a halt. Now that said, the easy way out is to say, well, as soon as we go back to work, this thing is going to go back down to where it was before, and everything is going to go back to normal. And maybe that's where it's a little naive to think that way, Louis. I think we can think of, if you're a business owner, let's think about a restaurant. It's easy to wrap your head around the business of a restaurant. You let go all of your employees because your business went from 100% to zero overnight. And then you're allowed to reopen. So how much are you going to rehire of these people? You're probably going to be very cautious, right? Because you can think of this. I think there is probably a permanent disruption to our life. I think that's going to be post Corona crisis. The same way there is a pre 9/11 and a post 9/11 world, mostly impacting travel. Travel has never been the same. I believe our social interaction may be affected more in a more permanent way, or at least maybe a more lasting fashion than we think. And I certainly hope to be wrong on this, but what that would mean is that maybe we're going to have an initial huge drop in unemployment, which would be excellent to get back people to work, but we may be left with some significant unemployment to work our way through. And that is only to maybe highlight something that we can maybe wrap our head around it.
Yeah, I mean it's very sticky when you let employees go. You think, like you said, you think twice before you put them back on. And I've heard some people say that there's going to be like another new normal. I know you remember the first new normal, right? After the financial crisis, but now there's talk of another new normal. And but I think there's a lot of realization that technology can make workplaces even more efficient. Like we're on Zoom right now, and that's helping us work together and not having to be, we're all having to work from home right now, but we're still able to be very, very productive.
Yeah, and I think I think you don't mean to interrupt, but I think you're putting the finger on something that is true. I mean, it was already a trend that people remote work was getting increasingly prevalent out there. But I think this kind of threw some companies in the deep end of the pool, and they have to learn to swim very quickly. And they may say, well, this wasn't too bad, and maybe we don't need to have everybody in a high price per square foot office, right? This is working pretty well, and maybe there is a more lasting impact. I think we are ahead of most optimist expectations as far as remote work. I believe now it's 28% of workers have some form of remote work, and they were expecting to reach. We're expecting to reach that percentage only by 2028, I believe. So I think we're well ahead of the curve, which is good for, of course, if we bring it down to business, which is in the end what we invest in, things, people like Zoom, I mean, there's good, it might be a hot stock right now from just its reaction to the coronavirus, but I think there's some very good fundamental macroeconomic trend that support those businesses in the long run. So this is what we're looking for, right? It's a good business with good underlying trends, innovative products, gaining market share. So you don't have to be, it doesn't have to be just thinking in cyclicality here. We can be on the offensive. There's some things that are working.
Well, we've been talking, that leads right into the fact that we've been talking about upgrading portfolios. And we've been in that process of upgrading portfolios because we've had an opportunity now to buy companies with solid business models at a better price. You know, we've had a 30% drop. We had a big move up from that. We've had a couple of big moves up, 16% move up and then back down, now 20% move up and then back down again today. But during that process, we've been putting on we kind of look at the market from a risk budget perspective. We say, okay, there's a certain amount of risk we're willing to take in the marketplace, and how much do we want to employ and deploy now? How much cash, not only just cash, but risk itself, do we want to employ? And right now we're sitting at less than a quarter of the risk of the S&P on our primary equity strategies. So like a day like today, we didn't have much downside at all. The market had a pretty nice down. But it also, what I'm excited about is the fact that we're able to buy companies like Amazon, some other names that we put on that are much more reasonably priced. But that doesn't mean this market can't go down from here. And I think that's one of the things that we're looking at right now. But getting back to the economy, the real economy, which is really what I want to focus in on, because I think one of the things that you and I discussed, I'd like to hear your thoughts on this, is that what if we compare this economically to the Great Recession that we saw before, the last financial crisis, this is as deep of recession in terms of real economy, right? It's close to it, right? So far.
I mean, as far as impact to GDP, both U.S. and global, it is right now estimated to be steeper than the great financial crisis.
But yet we haven't gone down as much in price in stocks. And the question is, do we have more to go?
That is the question, right? Either the market has underreacted to the potential both magnitude and length, lasting effect of that. I think people have anchored to this is going to be a 2-quarter impact and we're going to resume. And I think people still talk in those terms, and I think it's extremely misguided to think this way.
I agree with you. Yeah. That's really that's our whole point of this call today, is we had a brief phone call conversation. Is like we both came to the same conclusion. Like this, maybe this is a V bottom, but based on the data that we're looking at and the behavioral economics involved, it seems less likely, like less than 50%, that it's just a quick V, because of some of these behavioral things that with business in the real economy and putting people back to work. It's not like we're just going to switch a light and everybody's going to be back to work and everything will be fine. There's also a lot of stuff going on with the government. So what do you think about some of these packages, like for small business loans, abilities for people to, there's obviously people are getting checks and things like that, but is there going to need to be more stimulus? Because it makes me wonder about like all the supply chain problems that we're having. Is there even more you think the government's going to probably have to do?
Let's pull back. It's amazing how short of a memory we've had. I mean, how much is happening so fast right now. So the coronavirus, COVID-19, was the event that triggered the bear market and probably us going into a recession. But you don't have to go far. Just last summer, all we talked about was the tariffs, the global tariffs, and our trade wars with many countries, which really was a true risk to the economy, to the global growth, as well as as to be, was that going to be the trigger to the recession? It turned out to be something completely different that we didn't expect, as is usually the case. But if you think about that, there was already some things that were in place in reaction to that. Companies had already started to diversify sourcing of supply chains away from places like China into Southeast Asia, into Latin America, and many companies have actively started that process in response to that. Now we have a global crisis that pulled everything, disrupted the supply chain in the midst of all this. And we're seeing now China starting to go back to work, and it turns out that it's not coming back online as fast as people expected. I don't think that should be a surprise to anybody, but I think there is now starting to be a realization that this is going to take a longer while for the entire economic machine to get back to full work and to work its way through the global growth. Yeah. But on our side, I think if you think about what's going on for businesses, I think government is being aggressive right now, throwing trillions of dollars at it to give people some kind of a backstop. Even though these numbers sound massive, they really are a stopgap, and we're thinking in terms of weeks. I mean, we're not talking about something that has you mentioned earlier in our discussion, a multiplier effect. I don't think these spendings have a huge multiplier effect into the economy, right?
Yeah,
it's writing people a check, which is going to help them for a few weeks, or helping businesses with loans that could be forgiven to keep people employed until you get to the other side. That doesn't really have a huge multiplier effect into the economy later.
Yeah, I think people are thinking way too Keynesian, and they're not understanding that the domino effects and the multiplier effects and the behavioral changes that are likely to occur. So we don't know this for sure, but the probabilities have increased in my mind that we are going to have more of a zigzag bottom, not a V bottom. And we've been saying that all along from a technical perspective, from a stock perspective. I'm talking about the real economy. I think the real economy is likely to sputter. Now, the market is going to look through the real economy. It always seems to do that. Historically, the market will look through and bottom before it's obvious to everybody that it's time to buy. And so we're cognizant of that. So that's why we've been scaling our way and upgrading the portfolios. One of the things that I'm pleased with is that we have diverted a lot of this downside because we came in conservative. We bought long bonds, we bought gold, we pared back on equity exposure before this even started. And then the other thing that we did was we actually increased our ability to, I should say, we lowered our risk profiles. Normally we have a certain amount of range that we allow for our portfolios to move in and out of stocks. We made an exception because we saw the risks, and we allowed it to go further to risk reduction mode. And you have to, that's one thing that's key about managing money, is you have to be able to adapt to what's going on. And I'm pleased that we're able to do that. Now we're going to try our best to navigate through this. It's not going to be an easy one. I think this is going to be a little bit tougher. Now, I was going to ask you another question about complacency. Yesterday was my wife's birthday, and I went to Tony's and got a blueberry pie for her. She loves blueberry pie, and got some nice ribeye steaks, and it was awesome. But I noticed that people were congregating like nothing was going on, like talking right next to each other. And these are not family members. These are just people who are just, talking together. And I'm like, what are you guys doing? Where's the social distancing? And then I noticed that at Daniels Park over by where we live, people were just very complacent being next to each other. Do you think that, there's some risks involved with this that I don't think people are necessarily seeing yet. Do you agree with that, or is it just me?
No, I agree. We know it's not airtight by any means. Even in a state, we're in Colorado, where we are on a stay-at-home order, we still don't have all the state in the union. You look at the map, and it's actually shocking how many states still have only partial to none. So there is still plenty of spreading. We're nowhere near the peak of this thing, which reinforces my belief that there are some bad news still to come. There's some headline things that the market is not expecting and will react to. So our cautious stance, I'm extremely pleased the way we've navigated this volatility in this market so far. Again, we're looking at good businesses. We buy them at what we believe are reasonable valuations. You mentioned Amazon. Those are things that maybe I wouldn't have touched with a 10-foot pole a year ago from a valuation standpoint, and now we're being given a pretty decent shot at owning these good businesses. I'm also looking right now on my other screen at the style that have been favored by the market. And as we know, the bull market had been driven by momentum strategies, right? So all you needed to own were the winners with the FANG stocks. You needed to own 5 stocks year over year, and you would have done exceedingly well for yourself and beat everybody else, right? And everything else wasn't really working. Anything from value to earnings quality were not being really rewarded by the market as an investment style. If I just look for the month of March, it's been a complete shift in the focus. What you see on top are capital efficiency. That basically means it's that investors are starting to pay attention to things like return on equity, margins. So they're looking for good businesses, good capital allocators, good profitable businesses. You're looking at historical growth is coming back. You're looking at earnings quality. So the cat's out of the bag for sure. Everybody seems to be shopping for good businesses, and it shows up in there. So we are looking for that. It is a good time to buy, but I think where we add maybe an additional layer of value is we're not just going to buy these business because they look cheap and they look good and stuff them in a drawer and revisit in a year. We are going to manage the risk around these stocks, and we are going to put a backstop on it. If things roll over and it doesn't work, we're not going to be married to an idea. We're not going to get stubborn about it.
We can always get back in. We can always get back in those stocks. Yeah,
and we should own what works. So
we predefine the risk as before we go in. I agree. Predefine the risk. We can always go back in. Yeah, I agree with that 100%. And our volatility numbers right now are low, and we want to put more money to work. I think long-term investors should be, and we've been telling people who are asking us what to do right now, once you've got all your cash reserve stuff put away and all that, we're just telling them, send us the money. We'll put them in treasuries, and then we'll put them to work, and we'll scale you in. One of the things that happens is you have a stampede effect, and you see this every time. By the time everybody realizes I should be buying, the market's already bottomed, things have turned, and then everybody's kind of rushing, and then it takes time to get invested. The time, you want to have the money locked and loaded, ready to go in treasuries, ready to go. That's my thinking on this. Now, you don't want to just, you don't know when those opportunities are going to come in. A lot of people are just sticking the money in the mattress. They're sticking the money at the banks. You could see the liquidity demand, that came in the last moves, and we can go into a lot of details on that, but we don't need to. But so I think for long-term investors right now, it's a good time to have the money ready, but not necessarily plunge, right? We're not plunging.
No, and that's something, right? The money went under the mattress. You put it the right way. If you look at the asset flows, it didn't go from equity to fixed income, even though a lot of money went to fixed income. It went under the mattress. The largest asset class that got the money is money markets. And that's really our recommendation for people, whether you do it for yourself or you work with a professional money manager, is be ready to get in right now, because it's very easy to miss the first 20-50% move, and then you want to get in, and then there's less returns to be had. So hopefully you're ready to go. It feels counterintuitive right now. It may not even feel good to say, well, I'm actually going to put in more money in the market, but this might be the right time to be considering these moves to should I give more money to the market? The answer is
So
yes.
This leads to another interesting thing you and I were talking about. Sorry to interrupt. Hopefully I didn't interrupt you too bad. Well, fixed income, we're looking at, we have a lot of dry powder looking at the fixed income market. We've been scorecarding the instruments and saying, okay, what is the yield to maturity available in the marketplace? What is the duration? What is the credit risk? What are those, dimensions that we can look at the fixed income market, and where's the best place to be from a reward risk ratio? And it seems to me that there is a lot of credit risk that is not priced yet. Do you agree with that? Am I off base there?
No, you're not off base at all. I think there is the bond markets are giving us some signals right now that are interesting. I mean, if you think about a longer than expected impact of this, this recession being steeper and harder felt, there's a tremendous amount of companies that are investment grade that are on the bubble. They're just one notch above junk, that are at risk of being downgraded into junk status. That is, a tremendous amount of money in that, and you're seeing the market kind of rallying and giving with spreads that don't justify the kind of risk that you really seem to be seeing, that we seem to be seeing in there. So, is it a fact that there's just so much asset being taken away from liquidity and has to go somewhere? I mean, why would you buy a 10-year, even U.S. Treasury at 60 basis points? I mean, what is the idea behind committing capital to an asset class like that? That must mean that you must find everything else completely, worthless.
Taking duration risk is really only a diversification play towards ZIRP, towards zero interest rates. But if you're saying I want preservation of capital and the ability to move, within a reasonable time frame, it seems to me like you have to be on the shorter end of the yield curve. The yield curve is relatively flat. You're not getting compensated for credit risk, and it doesn't matter where you go. I mean, you're
not getting paid for time. You're not getting paid for credit risk. You're not getting paid. So honestly, that puts you very, very short on that curve. That's the only place that right now just makes sense to wait until we see a direction of either the yield curve or on the credit.
Well, some of the best fixed income portfolio managers had been going out on the credit, going lower credit quality, and that's hurt them. You look, they've had some big price hits recently. So I think knowing what you own is so important right now. And knowing what you own, don't be too spread out. Buy the stuff and invest in those things that have a higher probability of giving you a good return or safety. Don't just own everything. And I keep saying that. This environment even more so solidifies that in my mind.
No, it's true, and we believe that, which is a little contrary to the massive switch to passive and indexing. Right now, I believe, if there is a thing, I believe that it's time for active management to shine again. I think we can show our value in these times by making those more focused and conviction bets on either whether it's a question of on the stock picking side, as well as on the positioning of a portfolio, fixed income portfolios, and overall asset allocation. So I think everybody felt like a hero for the past 10 years, but I think now we have an opportunity to figure out that it takes skills to be successful.
It's a gradual thing too, because you have when after the crisis happened in 2008, right? 2008, 2009, everybody was unsure, and then as things got better, then people got more and more confident, and you hear more and more talk about indexing and why that's better than anything else, and then pow, you get nailed, right? If you're an indexer. And our approach has been more stable through the entire process. So we're not going to have as many big ups, not as many big downs, but it's more steady. And at the end of the day, you actually come out ahead a lot of times, most of the time, because keeping volatility down is very important in order for you to do well over the long term. And it's very interesting because a lot of people, I had a conversation with a client who multi-million-dollar portfolio, and they have money with us. They have money at a bank trust. And he's like, man, we lost everything in the market since Trump came into office. And he was looking at the index and he was looking at his account at the bank trust. Well, I pulled up our account and said, no, we didn't. We made money over that period of time. Well, what's the difference? Well, the difference is more steady. Buying those companies where the downs are not as big, And if you have companies that you're buying that are aggressive where they can have big downs, you truncate the risk and you try to focus in on upside growth when it's happening. You know, managing that downside is so important, and having diversification but not going crazy with it. You don't feel like you have to have every pie chart slice in your portfolio. You do not need every pie, you know, a position in every sector. You do not need a position in every industry. You can get diversification with diversified businesses.
I think you have blueberry pie on the mind, Louis.
What?
You have blueberry pie on the mind, I believe.
Yes, blueberries. So, well, anyway, is there any last words that you have, JP? I mean, it was a very good conversation we had before this, and I wanted to just hop on. I appreciate you.
It is. I mean, I think what I want to leave you with is that, I mean, we're looking at things from both sides, or from the top down and from the bottom up. And we're seeing good things at the stock level. We know what we want to own when the time is right. The other aspect is to do our best to try to control the overall environment, and we see some risks still on the downside. That's why we're being cautious in allocating capital to the riskier asset classes. So that's
but you know what? I wouldn't be completely out though. There are people.
No, there's a cost to this. There's a huge cost to being left behind, and it keeps me up at night. So we don't.
Unless you're like a really killer trader. Now I know some people who are really amazing traders, who that's fine. But for for the average investor, being completely out is usually not a good idea. So some of my trader friends will disagree. So. All right, JP, thank you so much, buddy. We'll see you next time. And this is Louis Llanes and JP Tremblay, WealthNet Investments signing off. We'll talk to you guys later.